Tag, ladies and gentlemen, it's the Financial Ape here. Welcome back to another one. In today's video, I'm going to be going over the anatomy of a bear call spread. But first, what is a bear call spread? A bear call spread is when you short a call and you're long a call but at a higher strike price. You create what's called a bear call spread, otherwise known as a call credit spread. Now, this is a bearish strategy, and this strategy always results in a net credit, meaning you get paid up front. It's a net inflow of cash. Now, how do you construct this, right? It's very simple. Now, let's say the stock of interest today is Apple, and I think that Apple is going to remain below $160 by May 20th, which is approximately in 31 days from now. I can create a bear call spread with my short call leg at 160 and my long call leg at 165. Now, both of these are in blue, which means I'm technically long both of these strike prices, but we're going to have to make a little adjustment by simply going to profile here. And then we make sure to select the 160 strike price, right? Because that's the one we want to go short on. So I simply click on the buy here. And as you noticed, it turns red immediately. That means I'm now short this leg and I'm long the leg above the short leg. Remember, you always short one leg and you long the other leg, but the other leg is always above the short leg. Leg in this case, you can interpret it as the strike price to keep things simple. Now, before we execute this order, we always want to make sure we review our max return and max loss, or you can refer to it as your reward and risk profile. You need to know what you stand to lose and what you stand to gain beforehand, all right? Don't go into a trade, never go into a trade blinded, never ever. So, as you've noticed, this strategy will always earn me money up front. That's why it's a credit. This negative sign, don't let it confuse you. It simply means that the broker is giving you this money. So from their perspective, they're experiencing an outflow of cash, and for you it's an inflow, but it still says negative. But just interpret it as I'm getting money. That's what a credit is, and that's what the negative sign means. And you'll notice this figure here, if you multiply it by 100, you get 290. It will somewhat match the number here, which is your minimum invest. It'll be approximately equal. Now, I know there's a bit of a discrepancy here, but it's only because I'm making these videos outside of regular trading hours. But keep in mind, these two figures, this one and this one, will be approximately equal, like 99% of the time, okay? And the margin impact here is the $500. Where does that come from, all right? Don't worry, it's very simple to interpret where that arises from. It's simply the difference of the 160 and the 165, which is $5 multiplied by 100, which is 500, all right? Now, 499.75, once again, as I just explained, market discrepancies because I'm making these videos outside of the RTH, regular trading hours, right? But it's approximately 500. Now, the max return, right? One of the most important parts of this strategy is you want to make money, obviously. The max return is $290. Now, this figure will once again match this figure up here because that's the maximum that I can make with this strategy. I can't make more than $290. And I'm sure you've noticed that if you take this number, your max return, and then you add it to your max loss, you get $500, all right? That's always going to be the case for a bear call spread. Your max return plus your max loss will always equal your margin impact. In other words, your collateral. On Interactive Brokers, they have this structure, and it's called a margin impact. but on other brokers, you might be more familiar with the terms collateral. They're one and the same, okay? So the max return is $290 and the max loss is $210. Now, how do you make money with this strategy? Well, it's very simple. If by expiration the stock price of Apple is at $160 or below, I'm in the clear. I take this $290, pocket it, and I get the full $500 in collateral back, okay? However, if I'm above $160, every dollar above, okay, is $100 knocked off my collateral. So let's say the price expires at 162, okay, or 61. Let's keep it simple. 161 by expiration. I still keep this $290, but I'm only going to get back $400 because I'm $1 above my short leg. That's how it works. When you are at the short leg, right? If the price expires, the price of the stock expires at the short leg, you're in the clear. If it expires below, you're still in the clear. Doesn't matter how low it goes, you're in the clear. So at $160 or less, you are in the clear. Everything is fine and dandy. You're living life. Life's good, okay? However, if I'm above $160, that's when things can be tricky. But a little trick, no pun intended there. For every dollar above your short leg, it's $100 knocked off your margin impact or your collateral. So ideally, whenever you construct a bear call spread, you want to be sure that the price of the stock remains below your short leg. That's when you win. If that's the case, you've constructed a successful bear call spread. However, if you are somewhere between the 160 and the 165, or even if you're above the 165, because I'm sure you're wondering what happens if you're above the 165, you can still never lose more than $210. That is the beauty of these types of strategies. You have defined risk and defined reward, okay? You have a max return of a certain figure, 290, and a max loss of another certain figure, 210. Doesn't matter if the stock price is, I know it's going to be a little bit of a hyperbole here, but let's say that the stock price is at 230. You still won't lose more than $210, all right? So that's the bear call spread. Hopefully I've clarified a few misconceptions. If this video has helped you in any way, shape, or form, you know what to do. Thank you for the continued support, guys. Have a fantastic day.